Good evening, class. My name is Michael Bolivar, and I'm a member of the Real World Finance class taught by Professor Mascaro. I'm here to talk to you today about the difference between a stock trader and an investor. So, people use trading and investing interchangeably in the stock market, while they're very different activities. An investor is an individual that uses their own money to purchase equity securities to gain returns in the form of dividends and appreciation and value. The general public associates the two market participants to be a stock investor. They believe in buy and hold strategies. They're more generally long-term investments. Believe in prospective futures of the corporations. Investments are based on fundamental analysis of the company's financial performance. Traders, on the other hand, they could be either a hedger, an arbitrager, or a speculator, and they're typically a short-term market participant. They're highly trained professionals that adhere to specific trading plans, focus on price patterns and technical analysis, and rely on supply and demand signals, market sentiment. And some of the most commonly known traders are the market makers, which they basically provide the liquidity and a rapid trading for the stock market. So, what is the value that each participant brings to the market? Well, traders provide liquidity for investors by always taking the other end of the trade. Traders and investors are necessary for the market to function properly, and traders are able to bring that price of stock closer to that true value. A value investor identifies an undervalued stock and buys the stock, creating a signal. So they, by holding that stock for a longer period of time, uh, it obviously keeps that stock, our stock market stable, so to speak. Traders alter the supply and demand in the market based on their short-term strategies and will normalize the overpriced stocks. And both parties, they provide a service by being counterparties of the two. They both create a pool of buyers and sellers, making the market vibrant. And the frequency of buying and selling in a secondary market also helps to the financial industry by paying the transaction costs to the brokerage firms. So the two obviously have their own risk management techniques. Traders, they have their own philosophy as they believe in their trading mantra, plan to trade and trade to plan. They also believe in an interesting philosophy where they associate that a particular stock's activity is driven by 50%. It's 50% of it is driven by the market sentiment. 30% of that stock price is driven by the actual sector that they belong to, and the other 20% actually has to do with the actual stock. That's important to understand. Price targets are calculated based on exit strategies, based on probability measures. Stop loss is used to limit those calculated losses, and strategies like option spreads are used to calculate earnings and hedge losses. Technical analysis is basically used to make that determination. Investors, they use the modern portfolio theory, mean variance analysis, in other words, the ANOVA. Expected returns are used based on what's known to us as CAPM. Alpha and beta is obtained through the ANOVA, through some regression analysis. Fundamental analysis is used to determine these viable opportunities. Technical analysis looks something like this, where they're basically focused on the charting. This red line would be known as the resistance level, and this blue line is basically the trend that they're foreseeing. So this is called candlestick charting, where they analyze the price movement and directional probabilities. Some of these candlesticks, they give signals, well, what's commonly known like the dojis, engulfing, haramis, and hammers, where these are triggers for either a bullish or a bearish change in the price. Some of the indicators that are used are also the 20-day, 50-day moving averages and the slope of the two, which could either give direction as it's extremely bullish, extremely bearish, or sometimes even sideways, butterfly strategies, if you will, which those are more option spreads. ATR is the actual true range, which is the dollar amount of a stock price, where it could either fluctuate on a given day. So, for example, an ATR of $1.50, that means that that particular stock price could either go up by $1.50 or down by $1.50. The fundamental analysis can be categorized into two: quantitative analysis and qualitative analysis. The quantitative analysis is obviously analyzing the balance sheet, income statement, and cash flow statements. The qualitative analysis, you identify using intangible aspects of the company performance by getting the price earnings ratio and intrinsic value by calculating obviously the value of the firm using discounted cash flow models, and even the dividend discount model, which is obviously some natural cash flow for the investor. Ultimately, the bottom line is there are some differences between the stock trader and the investor. So which one are you? Technically, you could be both, but you have to understand that if you're a trader, you have a strict trading plan that you cannot deviate from, and you eliminate any emotion to that particular stock. An investor, on the other hand, is more emotional, as they want a piece of the pie, and they're in part owners technically of the corporation. I hope you enjoyed this short video. Here's some references if you want to reference back to some of my research. Be sure to leave some comments for the class. Have a good night.